Yes, like I said, the course title is cost accounting, and the topic of interest is marginal cost techniques. The content of the course is as follows. It is expected that at the end of this lecture, you should be able to know what is meant by marginal costing and the contributions. And then you should also be able to calculate stock valuations using uh, a marginal cost. Yes, by the concept or by the definition or by the meaning of marginal costing, that marginal costing is one of those principles or strategy in cost and management accounting that is useful to concern with a change in cost resulting from change in volume or range of output. Uh, you know, marginal costing is basically a cost strategy that is more a focus on the resultant change in the volume of output or range of output. You remember, we in our previous lecture or in the previous video that I had with you, we itemized various costs that are attributable to cost accounting. And I told you that we are going to be applying this cost in our future lecture. So one of the cost strategy is the marginal cost. So in other words, marginal cost is also a technique of cost accounting, which again pay more attention to the behavior of cost with change in the volume of uh, output. Again, you also remember that under marginal cost, fixed costs do not form part of a production cost, but they are calculated or treated separately as a period cost. In other words, again, marginal costing consider only those manufacturing costs which have a tendency to vary directly with the volume of output in determining a production cost. What we are saying that marginal cost is one of the cost accounting strategy that are concerned with the marginal cost in terms of variable cost. When we say variable cost, we are making reference to direct materials, direct expenses, direct labor, and the variable overhead. The combination of these, if you remember, in our last lecture, the combination of these result to what we call contributions. For us to determine the contributions, it is the combination of direct material, direct labor, direct expenses, and variable overhead. Contribution here, it is similar to the financial accounting, where we are preparing the final account of, for example, the sole trader. The first thing we will do in the final account, we are to prepare what we call trading account. And the essence of preparing trading account is for you to determine what we call gross profit. Gross profit, these are profit expected to be that were derived or you are gotten during the trading activity of a particular business. So in cost accounting, contribution is a resembler or similar of that profit as in the case of marginal constant. So for you to get your contributions, which is the resembler or the like of the gross profit being a profit during a trade. So contributions, these are amount or a value of a cost that are attributable to the production process, and therefore contributions is equal to what a variable cost. The variable cost here is a combination of, again, the combination of direct material, direct labor, direct expenses, and variable overhead. So in my constant, one of the production costs also include fixed cost, or what we call a period cost as indicated here. So imagine when you apply marginal constant approach in determining the net profit or the net income of or the net production cost of a particular organization or production line, then you will need to first of all determine your contributions. Then thereafter you deduct the fixed cost, what we call a period cost. So a marginal constant does not take into cognizance the fixed element, the fixed cost element of a production process. Rather, it treated it separately as a period cost to determine the net production the cost. So the emphasis on marginal cost is more on the contributions than before determining your net production cost. This again makes marginal cost to differ from absorption cost, though the focus of this lecture is on marginal cost. So marginal cost take into cognizance under marginal cost, fixed costs do not form part of the production cost, but are therefore treated separately as a period cost. Whereby that's why marginal cost consider only those the manufacturing costs which I have earlier said, which include direct materials, direct expenses, direct labor, and variable overhead. Because these materials, the cost of these materials are expected to change. They are dynamic. They will change. The cost of materials today for the production of, say, a bread, isn't it, might change in the next 2 weeks or next month. So these are elements of what marginal cost. Again, direct labor. This is the amount of money you pay, a cost paid in the head on the personnel, isn't it, that undergoes the productions. The cost also expected to change. So marginal costs their tendency to vary, to change as volume of activities increase. If the cost of materials and the cost of expenses and the cost of direct labor and variable overhead that you use to, for example, produce, let's say, 20,000 units of loops of bread, for example, for this week, my decided to increase. If you decide to increase the production of bread to say from 20,000 units to 25,000, you don't expect the same cost of materials, labor, and expenses are going to be the same. And that's all. As the level of activities increase, marginal cost, the variable cost also increase. So marginal cost is trying to look at this, take cognizance of this dynamic to in the production process in order to determine what we call a production cost and again ascertain the net production cost. Hence, we'll see in these illustrations. We have an illustration here that a company called ABC Limited provide the following details for the year ended 31st December 2021 for preparing the income statement. This is a question with regard to a particular company that's into a production of process. That the sales for the year was 1,000 units and at the price of 10 naira per unit. That they will incur a fixed manufacturing cost of 2,000 to 2,200 to produce. That the quantity produced, the expected quantity produced for this company, production for the company include the 1,100 units. The inventory carried forward, those are the inventory that's left to be sold, is 100 units. Then variable manufacturing costs include direct materials to the price of 3 naira, direct labor 2 naira, variable production overhead 1 naira. Again, we also have the fixed selling and administrative expenses, which also amounted to the tune of 500 naira. The question is, we are required to determine the cost per unit of finished good and again prepare the income statement of the company using marginal cost. These are informations provided by company A, B, C, with expectation that he expected to make a sale of 100 units at the production cost with the production capacity of 1,100 units. The actual production is 1,000 units, but we are left with 100 units of stock that is yet to be sold, and as such, this increased the quantity from 100 to 1,000, including the leftover unit or so. Then the costs that are expected to be borne, to be spent, to be incurred in to produce this quantity of production is 2,200. That cost comprises of direct materials, which is expected to be incurred, which is last for 3 naira per each. Direct labor is 2 naira each, while variable overhead cost is 1 naira each. Then the question is, I should determine the cost per unit of finished good, bearing in mind that the fixed selling and expenses is to the tune of 500 naira. Now, the solutions for us to determine the cost per unit equals to marginal cost per unit. And the marginal cost per unit for this material, as we are given, the direct materials for that the cost of the price for the materials, for each materials that will be purchased is 3 naira, direct labor is 2 naira, while variable overhead cost is 1 naira. So total cost per unit is 6 naira. It will take this company 6 naira per unit to be able to produce 1,100 units of the finished product. And the 6 naira is in combination of what? 3 naira for direct materials and 2 naira for direct labor, while variable production overhead is 1 naira. So we have this 6 naira is the cost per unit as per requirement number 1. Then the requirement number 2, who asks us to prepare the income statement for the year ended 31st December 2021. The income statement in respect of ABC company. Income statement is similar to what we call the profit or loss account as we used to have in financial accounting. So the income statement will give us the efficacy or the performance or position of ABC. The item you need to bring first in your income statement is the sales. And the company expected to make sales of 1,000 units at 10 naira each. So the total value of sales, the expected total value of sales is going to be about 10,000 as reported in the, here. Then the next item to look at is you deduct the variable cost of sales. The variable cost of sales here include the manufacturing cost, and the manufacturing cost is 1,000 for 1,100 units of finished good. Of course, remember the cost per unit is 6 naira. So cost per unit, the total cost per unit is 6 naira. So 6 naira will be used to produce the total unit of 1,000 units. So the total value of to produce the manufacturing cost of manufacturing product production cost of 1,000 units is 6 naira. So if you multiply 6 naira by 1,100 units, the value of manufacturing cost would be amount was 6,600 naira. Then out of this 1,100 units, you remember that 100 units were left over on sales, which were carried forward to the next year. So for us to also determine the value of the closing stock, we also bring in the cost per unit multiplied by the 100 unit carried forward. And again, the result, the amount is 600. So the difference between the manufacturing cost and the inventory cost at the closing at the end of the period is 6,000. So 6,000 divided by 10,000, which is our total sales, will result to what we call a variable gross margin. Then, for us to determine operating contribution margin or contributions that will not less our first variable sales and admin expenses, which again was given as 400. So 400 minus 4,000, which is our variable gross margin, is equal to 3,600. The 3,600 represent our operating contributions. Hence, you remember that for you to determine the net income of a production process, there is need for you to separate the period cost or the fixed cost from the contributions under the marginal cost approach. Now, the fixed cost element in this question comprises of what? Manufacturing cost and the selling and admin cost, which is amount to what? 2,200 and 500 respectively. So in total, 2,500 and 500 respectively will give us the balance of 2,700. So if we minus 2,700 from the value of the contributions, hence is our net income. So this is the income statement for ABC Limited for the year ended at 1st December. You could see from this statement, in preparing the income statement using the marginal cost approach or marginal cost strategy or techniques, is that it separates from the definition, it separates the variable cost from the period cost. I told you already for period cost is a fixed cost. So in determining your net income, you must separate the fixed cost or the period cost from the variable cost. Of course, the difference between total sales, the total value of sales, and the total manufacturing cost will result to what we call the contribution, which is similar to what Elias mentioned as a gross profit. But in determining your net income, you now bring the value of fixed cost now from the contribution margin to arrive at your net income. This is what we have. This is one of the quick, one of the illustrations or examples of a marginal costing techniques of the cost accounting.